Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is the world's largest telecommunications company and the second largest provider of mobile telephone services. The company began its history as the American District Telegraph Company, formed in St. Louis in 1878. It launched as an independent company in 1983 when U.S. regulators forced the breakup of the Bell system monopoly. It spun off its subsidiaries into regional carriers. The company paid $102 billion for Time Warner 3 years ago. It plans to sell Time Warner for $43 billion to Discovery. This transaction was set up as the reverse Morris Trust, which allows a company to spin off and sell assets while avoiding taxes. The $43 billion will be used to pay down debt, and that will save AT&T $2 to $3 billion per year in interest payments. The deal has not been finalized, so we do not know for sure if AT&T will receive cash or debt or some combination of both. The new entity will consist of 100% of Discovery, the entire company, plus the Time Warner division. And most of the value of this new company is from the Time Warner part. The Discovery part brings in a lot less revenue and cash flows than Time Warner. Since Time Warner will be carrying the weight for this new company, that means the AT&T shareholders will own 79% of the new company. Because if you're an AT&T shareholder, you'll be losing all those cash flows from Time Warner. The current shareholders of Discovery will own 29% of the new entity. Once this merger is complete, there's going to be two companies. One company will be AT&T, ticker T, which will be just its communications business. And another company will be Discovery plus Time Warner. And I'm not sure what that ticker will be. AT&T said the main reason for the divestiture is to become a pure-play communications company similar to T-Mobile and Verizon. Also, the margins are higher for its communications business versus its Time Warner division. The company is headquartered in Dallas, Texas. It was founded in 1983. It can be found on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Zicha, Vienna, Swiss, Colombia, EuroTLX, Sao Paulo, Lima, and Buenos Aires Stock Exchange. Let's get started with the model. This is a large cap company, 174 billion market cap. They're trading at $24 a share, and they have 7.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they generate a lot of free cash flow, $22 up to $29 billion a year. Free cash flow is a cash flow that's remaining after paying all your expenses. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's high in 2018 and 19. It is negative in 2020, a small positive in the trailing 12 months. Revenue is a sales for the company, and that's really high, peaking in 2019 at $181 billion. This is their income statement. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue. $139 billion from communications, $30 billion from Warner Media. The $30 billion will be going away once they spin off this division. In the communications bucket, $73 billion is from mobility. If your cell phone provider is AT&T, then you're part of this revenue right here. Video is really big these days, especially with COVID. They generate $29 billion from video. Broadband internet, that's $12 billion, and they generate $25 billion from businesses. They generated $3.1 billion from Vrio. This is video services in Latin America and the Caribbean. In a little bit, we're going to go through the income statement, and I'm going to show you they're going to pass through a large write-off in 2020. Part of that is a goodwill impairment for Vrio. And they generated $2.6 billion from people in Mexico. This is for their telephone and video services. A nice thing about investing in this company is you get revenue from all around the world. Although bulk of it is in the US at $156 billion, $5 billion in Europe, $2.9 billion in Mexico, $1.8 billion in Brazil, 2.7 billion in all other Latin American countries. Asia Pacific Rim is 2.3 billion and 800 million in other. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That peaked in 2019 when they had the highest revenue. Below that is their operating expenses and then their operating income, which is coming up a lot in the trailing 12 months. It's much higher than 2020 of 25 billion. It's up to already 28 billion. And the revenue isn't that much higher in the trailing 12 months when compared to 2020. So it looks like they're becoming more efficient. The big thing with AT&T is the amount of debt they have. They paid over 7 billion of interest on their debt, which was lower than 2018, 19, or 20. And the bottom line of the income statement is their net income. And they had high net income in 2018, 2019. The reason it was so low in 2020 and the trailing 12 months was these large negatives in other income and expenses. Let's look at their 2020 income statement in a little more detail, and I'll show you why. Here's a breakdown of their revenue in services and equipment. If you use the company as a cell phone carrier, that's part of services. And they also sell physical equipment. You can buy phones at the AT&T store. Also, the company comes to your home or business to install certain equipment. A bulk of their expenses are on operations and support, 118 billion. The reason their net income was negative was this $19 billion impairment. 10 billion was a goodwill impairment and 7 billion was long-lived assets. Long-lived assets are assets that have a useful life above 12 months. These are non-cash items. AT&T looks at its balance sheet and identifies assets that may be overvalued, so they write them down. There's no cash involved. And a goodwill impairment is when you write down the value of a business that you overpaid for in the past. They decreased the goodwill of Rio $2 billion. That's the company in the Latin American division. And they decreased the goodwill on their Warner Media division, 8 billion. So in 2020, they reported a loss of 3.8 billion. I'll show you in a statement of cash flows, they actually generated lots of cash. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So even though they reported a loss in 2020, they actually generated $43 billion of cash flow. So you can see this company generates a ton of cash flow. Most companies won't generate $40 billion in their lifetime, let alone 1 year. They have to spend a lot of money into CapEx each year. $15 to $20 billion a year. Operating cash flow minus CapEx gives you your free cash flow. And the free cash flow is the cash that's remaining for you, the investor. Usually about half their free cash flow goes towards a dividend payment. They use the rest to pay down debt, buy back stock, or maybe invest back into the business to grow it. In 2019 and 2020, they added about $15.5 billion of stock. But you can see they're not buying back nearly that much stock. So they're adding more shares than they're buying back, which means they're diluting you, the shareholder. The more stock a company issues, the more it dilutes the shareholders. They also add a ton of debt every year, and it looks like they're paying down a little more debt than they're adding. This is the cash flow from operations section in the statement of cash flows. And the way you calculate CFO, you start with net income or net loss, that was 3.8 billion. Then you have to add or subtract the non-cash items on the income statement. They have lots of depreciation because they have lots of fixed assets. 28 billion of depreciation that has to get added back. That $19 billion impairment has to be added back. That's a non-cash item. 8.6 billion of amortization of film and television costs. That's going to go away when they spin off Warner Brothers Media. You can see there's a ton of things to look at. It could really make your head spin because there's so much to try to understand. It makes it really difficult to value this company. But I just recommend to focus on the high level, and then over time you'll learn more and more about the details. So the high level is that they generated $43 billion of cash flow in 2020. They spent $13 billion of cash flow in 2020 from their investing section. $16 billion was from CapEx. They spent $1.9 billion in acquisitions. They received $3.6 billion of cash from selling part of their business. They had a cash outflow of $32 billion from their financing activity. They added $9.4 billion of short-term debt. They paid down $9.5 billion of short-term debt. They added $32 billion of long-term debt, and they paid down $40 billion of long-term debt. They bought back $5.5 billion worth of stock. They paid out $15 billion of dividends. Once again, your head can spin looking at all these details. But I would just focus on the high level, how much debt they issued, how much debt they paid down, how much stock they added, how much stock they bought back, things like that. This is the equity section of their balance sheet. They have 181 billion of equity. They raised 137 billion from selling their business. They profited 41 billion from running their business. And the reason retained earnings is so low is because retained earnings is a sum of all your prior net incomes minus the sum of all your dividends you paid out. And they pay a lot out in dividends, so that's why their retained earnings are low. If they didn't pay any dividends, their retained earnings were really, really high. They bought back over $17 billion of stock. Non-controlling interest means AT&T owns less than 50% of another company. So AT&T may own 20% of another company, and this is the equity value of that company, $17.5 billion. Whatever AT&T owns, whether it be real estate where their employees can work, or telecommunications equipment, or another company, that all belongs to the balance sheet. Because that's owned by the investors, me and you, not the executives at AT&T. Let's look at the capital structure. They have 181 billion of equity, 202 billion of debt. They have 47% equity, 53% debt. Their net debt is 181 billion, and their WACC is 7.5%. I gave them the highest WACC on Finbox, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 418 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $384 billion. We divide that by 7.1 billion shares. And we get a calculated stock price of $54. They're trading at $24, so they're trading at a 55% discount. It's a strong buy according to the model. So I tried to be really conservative with my future free cash flow estimates. I assumed that 2021 would be worse than their trailing 12 months, which I don't think it will be, but I'm just trying to show you in a really conservative scenario how undervalued AT&T is. And AT&T said their free cash flow in 2022 should be about $20 billion since they won't have Warner Brothers Media anymore. And I just grew that by 1% for the next 2 years. Really minimal growth. And I'm still coming out with the stock price a lot higher than they're trading at. And the company did say they are going to cut their dividend probably down to 4 to 5%. Later on, when we look at the historical stock price, you'll see where the stock crashes during that announcement when they said they're going to make the dividend cut. So when you value a company, you have to look at the future free cash flows that company will generate. That's how you value any asset. Now, the company can do anything they want with those free cash flows. This company pays a lot of it back to you, the investor, in the form of a dividend. Some companies, like tech companies, don't pay dividends. They reinvest back into the company to grow it. So your stock price goes up a lot more. So AT&T stock price and most companies that pay a big dividend, the stock price generally doesn't go up that much. Or at least not as much as it would have been if they didn't pay a dividend. You have to consider that when investing in this company, if the stock price is not going up, it doesn't mean you're not making any money. Let me just give you a simple example. Say you invested $10,000 into a company that paid a 5% dividend, so you get $500 every year in dividend payments. Say it was an annual dividend to keep it simple. Once a year you get $500. This is kind of how a bond works, but let's just pretend this is a stock. And let's say the company paid 100% of its free cash flow in the form of a dividend. So everything it made, it gave back to you, the investor. Let's say the market worked perfectly and there were no fluctuations in the stock price. Because as you know, a stock price can go way up or way down without the company really doing much. But let's say the stock was flat. The $10,000 you invested in this company was $10,000 every year for the next 10 years. It never went up. If you showed your friend your portfolio and he asked, when did you invest in this stock? And you said 10 years ago. And your friend asked, how much did you invest 10 years ago? And you said $10,000. And your friend says, but you have $10,000 today. I hope you don't think you made no money on this stock because you still have your original $10,000 investment. But you receive $500 every single year. And you use that money to go on vacation, to pay rent, whatever you want to do with that money. But let's say your other friend also invested $10,000 into this company, but every single time he got that $500 dividend, he bought $500 of stock. So after the first year, he would have $10,500 of that stock. The second year, $11,025. And after 10 years, he shows you his portfolio and says, we both invested $10,000 10 years ago, but I have $16,300 and you have $10,000. I'm doing a lot better than you. That's not true. You're doing the same. You just put it back into that company and that 5% dividend compounded. So if the company never paid a dividend, your $10,000 investment would be $16,300 today, assuming there were no fluctuations in the market. To bring it back to AT&T, if you put $10,000 into this company and then your $10,000 was only $13,000 after 10 years, you can't think of it as you only gained 30% after 10 years. You have to consider all those dividend payments. So a DCF model works perfectly for a company that does not pay a dividend. It still works for a company that pays a dividend, but you have to remember the stock price will not appreciate nearly as much. Because when a company pays a 2% dividend, the stock price goes down 2%. Because they're taking 2% of the cash out of the company. So mathematically it has to go down 2%. It could go down more than 2% based off of market fluctuations, or it could actually go up if the market is really bullish that day. But mathematically, it has to go down 2%. Outside of that, we can't really predict market fluctuations. Simply Wall Street's valuation is $98. Wow, that's really high. A 75% undervalued stock. 8 analysts priced this stock and the average price target is $31. This is where the stock has been trading the last 5 years. So it looks like it was in the low 40s in 2017. And you could see it's come down quite a bit since then. And this big drop right here, this is when they announced they were going to spin off Time Warner Media and cut their dividend. Investors were not happy the company took a big loss on Time Warner Media. But the main reason the stock went down so much is because of the proposed dividend cut. Most people that invest in this company do so for that nice dividend payment. People like that security of a dividend payment. And this big crash right here, this looks like around March 2020 when the entire market crashed. They have a beta of 0.66, so the stock moves less than the market. It's not volatile at all, which is what you would expect with AT&T stock. It's pretty much a turtle. It moves really slowly. The stock has gone down 13% in the past 52 weeks, while the S&P is up 31%. The 52-week low was $24. The high was $34. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. 40 million shares are traded each day. Pretty much all the shares outstanding are on float. Half the shares are held by institutions, and a little over 1% of the shares are shorted. They pay a really generous dividend, 8.5%, which is almost 60% of their free cash flow. But that dividend will be cut once they spin off Time Warner. And they do pay a higher dividend than their industry, 6.5%. Analysts are forecasting their dividend to decrease to 7.9%. But obviously this is not correct because we know their dividend is going to come down a lot more. Their employee count has been coming down a bit the past few years, but they do employ a ton of people, 231,000 employees. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $15,000 today. That's a 50% return, a 4.4% annual return. It would have been over $20,000 last year, but the stock has come down quite a bit. There's no insiders selling this stock, but there are a bunch of insiders buying the stock. Vanguard is the biggest shareholder at 8%, then BlackRock, State Street, Newport, and Geode. Let's look at their financial ratios. Their PE is not so good because their net income was really low due to all those write-offs. They have a great price to sales of 1.0. That means their revenue equals their market cap. That's much better than a market median and average. Their price to book is also really good at 1.0. Price to book is stock price over book value per share. And to calculate book value per share, that's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. It's the value of the company according to the balance sheet. But their tangible equity is negative $129 billion, because they have so much intangibles on their balance sheet. Their ROIC is a bit low at 6.3%. Even though they have lots of debt, they can cover their interest payments 4 times. They have a really low ROE due to the artificially low net income in the trailing 12 months. And they always have a low current ratio and quick ratio, 0.7. That's just how they operate. And their current assets are $57 billion. That's $21 billion of cash, $16 billion of receivables, and $16 billion of prepaid and other current assets. So they do seem to be undercapitalized, even though they bring in $26 billion of free cash flow, which is just mind-boggling how big that is. They have negative $24 billion of working capital. They pay out $15 billion of dividend payments, so they're short $13 billion of funding. But as you know, this company takes on a lot of debt, so they're just going to add some debt to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as AT&T, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They are worse in PE. They're much better in price to sales and price to book. Many companies in this industry have a current ratio below 1. When a company brings in lots of cash flows, they generally don't have a high current ratio because they don't really need it. They always have lots of cash flow coming in, so they don't have to sit on a lot of cash in their bank account and earn no interest. They rather deploy the cash and use it to grow the company or to pay a dividend. They have a low ROE, they're about average in debt, and they're one of the bigger companies on this list, $174 billion market cap. The only other company that's bigger is Verizon, and they currently pay the highest dividend of all these companies. So to summarize, I have them trading at a 55% discount. I think it's a great move they're getting rid of Warner Brothers Media. They probably should not have bought it in the first place. I know it's easy to say after the fact, but they're a telecommunications company, not a streaming company or entertainment company. Leave that to Netflix, Disney, or Discovery. That's their niche. This company should just focus on telecommunications. So I think once they get through all this mess with the disposal of Time Warner, I think the stock price will start coming back up. But it could take another year or two, or possibly longer. That's the hard part, waiting. I ranked their free cash flows and revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.